So this is going to be very simple compared to what we just heard from Preston. But when I've been coming to these meetings, there's been discussion of derivatives, and some people have asked, well, what are derivatives? So the idea behind this was to just provide a very basic overview. My background in this comes from the chemical industry. I created a company about, in 1995 that was one of the first online transactional exchanges for commodity chemicals. We were doing futures, forwards, and swaps. And it came from this specific problem I had when I was in the chemical industry, is that we sold and distributed chlorine and caustic soda. And the economics of it is they are produced according to the laws of nature in a fixed ratio of 70 pounds of chlorine for 80 pounds of caustic soda. But the demand for these two things are completely uncorrelated. And when you have housing booms and a big demand for PVC, there's a huge demand for chlorine, which goes into PVC. So to fulfill that demand, they also make a lot of caustic soda for which there is no demand. So the price for chlorine may go way up and the price for caustic soda may go way down. And likewise, when housing contracts, now there's still this demand for caustic soda but not demand for chlorine, so the prices are counter-cyclical. And this happened to me when we were selling our business. And normally when a price increase is announced, then you pass those along to your customers. And everyone sort of accepts that. But when your business is for sale, your customers are then negotiating with you about, well, maybe it's time to change suppliers. And so you're trying to prove to your buyer that your customers are loyal, hence the value of your business is what it is. And I just wish there had been some way I could have hedged the price of caustic soda. And there was no way to do that. So the internet seemed interesting, and we created a company called ChemConnect that built these kinds of a platform for trading commodity chemicals. So the idea of derivatives is really simple. It's derived from the value of something else. An underlying asset, index values. There's usually a time component to these. Sometimes weather. I went to the Enron trading floor, and they were trading in weather futures, which is pretty cool. But it made sense because it was correlated with crop production. So they'd build a whole set of products around weather. You basically have forward contracts, futures, and options. And the people that are buying these usually have three things that they're looking for. If you're a producer or consumer of these physical products, you're looking to hedge, like I was willing to do with caustic soda. Or if you grow corn or soybeans, you may be doing that. You may be interested in trading in some derivatives. Arbitrage is looking for a riskless way to make some money. If you see that there's a disparity between markets, what one market values an asset at another, you can take a position in both and make a profit with almost no risk. And then there are people that are really betting on this. Derivatives are traded in a couple of different ways. Over the counter are just, me and you trading products. We know each other. But that's not very liquid. So exchanges have been created that allow people to trade with anyone. So the simplest one is a forward contract, and that's simply an obligation to buy or sell an asset at a future date. If you think that the asset's going to be worth more than the delivery price, then you're taking what's called a long position. So if I'm growing soybeans now, someone may want to buy that because they think, let's say $1 a bushel or whatever soybeans are traded in. By buying that now, they think it's going to be worth more at the delivery date. So they would be able to take mine for $1 and then turn around and sell them for $1.25. And taking a short position is the exact opposite of that. These usually cost nothing to enter the contract, and they're usually over-the-counter type of transactions. And you can't really see this, but that's basically the economics of a long position and the short position. Is that you've got in a long position, there's a higher payoff when the price at maturity is more than the delivery price. and short positions the exact opposite. Futures contracts are like forwards, but they're traded on an exchange and they're standardized. In an over-the-counter transaction, I could create a deal for 123 Bitcoins on September the 7th. There's not a big market for those probably, but if we put them in 100 Bitcoin lots and said it was always at the end of the month, the end of September, then there's more activity, and that's part of what an exchange provides. The exchanges also manage the net positions of traders and provide a lot of services, and that's kind of where I want to get to with this. Most of the futures positions are closed out prior to expiration, so no one actually takes a delivery against a futures contract. But what it does is it provides a mechanism for price discovery and managing risk throughout the process. Options are the things that I think are the most interesting. It's the right but not the obligation to buy or sell, usually by a certain date. There's actually two kinds of options. There's what they call the American option, where you can exercise that option anytime up until that expiration date. And then there's what they call European options, which is where you have to exercise it on that specific date. But most of them are American options. There are two kinds. There's a call option, which is the right to buy, and a put option, which is the right to sell. But unlike the forward contracts and futures, you have to buy these options. It's a pay-to-play type of thing. And the price of the option is going to depend on the strike price and expiration date. Typically, these are traded on exchanges, and the exchange will set the strike prices based on the movement of a stock or the underlying commodity during the process. And I'll give a couple of examples, and I'm just going to fast forward to the end here because this is fairly basic stuff. But with a call option, let's say Bitcoin is going for $485 today. I don't know exactly what it is. But if you think it's going to go up, you could buy a call option, and maybe it costs you $10. Your net profit's $10. Let me fast forward this. This is a better example. Why options are cool and dangerous is the amount of leverage that they provide. So going back to this example that I started, if the spot price is $485 per Bitcoin, and you think it's going to be more than $520 per Bitcoin in, say, the next 30 days, you could do a couple of things. You could buy Bitcoin now and hold on to it, a buy and hold strategy, and then when you sold it, you would make a nice little profit. Or you could buy call options if they had a $10 price on them and exercise those options and make 100% profit. So options are really pretty attractive, but they're also very dangerous. In the first scenario, you're not risking so much in loss. In the second scenario, if you're wrong, you could lose $10,000. Most people don't, and there's these different payoffs which we can go through, happy to talk about them. But most people don't take, and this is very faint, don't just trade in options. Usually they combine it with a long position in the underlying security. Let's see. Okay, there we go. And it's a way of managing your risk. A covered call protects you against a really a spike in a price. Okay. Sorry I'm going through this fast, but Christian wanted me to do it fairly quickly.
Well, you can take, I think it's very good content, so let's...
Okay, well, take it slow. So a covered call is a way where you can combine a position in the asset, combine it with a call option, and manage your risk. So it's a combination of having a position in the asset and an option position. This allows you to protect yourself in case the asset price really takes off. But the downside of that is you don't get the full appreciation of the asset, but you're managing your risk. Another common way, common option asset combination is what's called the protective put. Remember, a put option is the option, gives you the option to sell an asset at a certain price. And in this case, what you're doing is you're limiting your downside. If the price of the asset is actually less than the strike price, then you're protected. You have a way of limiting your loss. What gets really cool with options, though, is when you combine them in different ways. You can get two call options or two or more put options, and based on the timing and strike price, create all kinds of payoff scenarios called spreads and straddles, strips, straps, strangles, and there's a whole variety of different names for them. So what's interesting to me about all of this is that what is a way to build an exchange on Ethereum? The centralized versus decentralized. Certainly you can program all these different kinds of option contracts in the language. But you think about what services the exchanges provide. You know, there's got to be a quoting process. How do you quote on Ethereum? How do you match buyers and sellers? And how do you manage the counterparty risk? Traditional exchanges have margins and net position management. If you write an option, you know, let's go back to the thinking about a call option where I have the right to buy at some price that's below market price. If I exercise that option, whoever wrote it then has to service that. They have to go out and sell at me at below market price. What if they can't? So there's a lot of counterparty risk that exchanges mitigate. Part of that is by knowing who they are and making sure that they have the liquidity resources to stand behind the contracts they write. The other is managing margins, and it gets very, very complex. So I'd like to think about, I'm interested in thinking about how this would be done on top of Ethereum. So that was a very quick run through financial derivatives. Happy to answer any questions. People in this room probably know more about them than I do, but we created a lot of these products on ChemConnect, and I think it'd be fun to create them on top of Ethereum.
That was very...
When you say create them on top of Ethereum, are you talking about trading crypto?
I'm talking about being able to, if you want to, say, convert Bitcoins to dollars, be able to create call options for doing that.
Trading crypto?
Yeah.
No, you could trade derivatives based on anything, really, because you could. I mean, this is one of the reasons why smart contracts support external oracles, is that like you could have some sort of external oracle that says this contract pays back this much Ethereum based on the price of that external value.
Sure. Looked up on
from some data source.
So what's he using Ethereum for? I mean, Ethereum is based on the blockchain, isn't it?
Yeah, but so what Ethereum can do is it can take an external feed. You could get a Bloomberg feed of what the Bitcoin to dollar exchange rate is.
You might be able to do this easier on the whiteboard.
Yeah.
Yeah, it's like.
Well,
yeah.
So, no, I'm just wondering what your objective is.
Okay, your objective is to trade securities, is to create securities without creating corporations, without creating a legal entity.
Basically get rid of your armies of lawyers, accountants, bankers, regulators, etc. Replace them with a cryptographic proof of what's going on with these contract executions.
So you have signed source code that you know will be executed, that you trust the network will execute.
Right.
And you know the outcome of that source code is tied to some trusted third-party data source.
Sure.
Like think of all financial middlemen you can think of that make the financial system work, and then you can probably figure out ways of replacing them with smart contracts or DAOs on the Ethereum blockchain.
So I can fire my bank.
One way to think about it.
We'll see.
No, you can. You can fire the New York Stock Exchange. That's the idea.
That's what I'm seeing.
Well, but so there's all kinds of problems along the way. You don't need to think it's not quite all solved. For example,
Brian said it was, or Preston said it was 10 years out on a good day.
Yeah, I think he was going a little bit too far out. I think that it's possible for things to happen sooner. But for example, you're talking about, what was the word you used? This trusted. You didn't use the word trusted data feed. You used something else. Oracle. So that's actually a bit tricky to mix. That involves some centralization.
Yes.
There's some ways. Vitalik is excited about
multiple sources of the same data, so they verify.
So you might also just be looking at the jobless reports from the government. Whatever your oracle, whatever your source is kind of irrelevant. You can take any source.
But it's an attack vector.
No, I mean you can attach any source.
Yes.
Whether it's the jobless rate or
and when you bought that,
it's got to be trusted.
When you participated in that contract, you knew who the source was. and you know that that source isn't going to change, and you can make some sort of judgment.
Trusted source, sure.
One thing that's nice is the easiest derivative we talked about is the forward, and it requires no oracle.
Yes.
Yeah.
If you
First one to do.
Yeah.
Do that, let's do that.
If you want to just hedge.
The forward, I'm gonna sell my house to you for 110 grand next year at this date.
Right.
Or the way it works in the chemical industry is, I'm selling something overseas and I'm getting paid in euros. I want to make sure I don't have exposure to currency risk. So I'll go ahead and make forward contracts for currency exchange now, so I can lock in what my profit will be. That's a very simple, common thing to do. These are typically over-the-counter transactions where you know who the counterparty is. So that takes some of the risk out of it. From my perspective of trying to create liquidity on an exchange, it's hard to do that matchmaking, right?
Yeah.
So what an exchange does is it says, well, you don't have to go out and find someone, we'll find someone for you. Everyone comes together here, and we match buyers and sellers together.
Sure. Yeah, I get that.
And so if you had a smart contract like this, everyone on the blockchain who was looking at the blockchain would be able to tell whether or not that smart contract is solvent at any given point in time.
Exactly.
And under what conditions it would be solvent. It would be relatively easy for anyone to model. So then you don't really have, so like with an exchange, we rely on a regulator to tell us whether or not the exchange is solvent at any given, on any given point in time. A smart contract, you can just go look. And so, I mean, like, this is what happens, like, when you have a financial collapse, is that all of a lot of derivatives instruments suddenly become insolvent, and then
You mean
nobody
they were
can figure out what
leveraged?
their counterparty risk is.
You mean they were leveraged?
It's not just that, it's that, okay, so like you are assuming in your models for your exchange that there's going to be roughly a match between people who want to take a long position and a short position on any given thing. And you have some space around that that accommodates for, let's say, a 10 or a 20% price change in a given trading session.
Sure.
And like, but if the price changes by 50% in a given trading session, whatever your capital reserve was is now irrelevant. And so, but that counterparty risk then propagates through the financial network, and that's how you get 2008.
But you go to like Chicago Board of Trade and a lot of these exchanges, they maintain margin accounts as part of ways to try to mitigate that counterparty risk.
Well,
And they'll do margin calls if there's a price swing that's too large, then they'll do a margin call to just.
but then you end up like what happened, which was AIG was taking everyone in the world's counterparty risk.
And then everyone in the
And
world
so then
was
it all just got transferred to the Fed.
Margin daily. I
mean,
mean,
there's the
the
problem.
problem that you're trying to solve is a problem that the exchange is trying to solve, and it will be irreducible, right? You can automate an exchange because an exchange forces you to post a margin. You can have a smart contract that does the transfers between margins that exchanges do now. But ultimately, there are two counterparties. In a derivative contract, the risk is quantitatively indefinite for many.
Yeah.
Right. There's for a call option. If you write a call option, the price of something can go up indefinitely. The loss to the writer can be indefinite. Eventually, no matter how smart your contract is, the writer of the option may simply not have the economic
You can
capacity.
make a smart contract though that has non-linear
Sure.
tail risk.
Right, exactly. At some point, it's going to have to write off. That you're going to write in the contract the bankruptcy
So,
proceeding.
exactly.
Basically, of the writer.
So you can have, your
Right.
code can be non-linearly linked to the underlying price of the object.
Right.
And then everybody can model their risk.
Right.
But here's the neat thing about an exchange. An exchange can see what your net position is and what your net worth is based on all the different contracts that you've got. And they have the ability to then start unwinding contracts if you're overexposed to some extent. But what's the way to do that on the blockchain where you could see what are all my different positions out there?
Well,
Can I actually stand behind this or not?
If it's a privately held blockchain, if it's Goldman Sachs' blockchain, then they're going to keep track of all your assets. And to them, all it is an accounting ledger. But it's an accounting ledger that they can execute like that compared to using a myriad of accountants.
And they can't cook the books, so internally, just using a blockchain internally
It's just an
as a
accounting
bank
ledger.
and not exposing it is still useful.
Oh, very
I
useful.
mean,
It's
they're
just
gonna,
an
they're gonna
accounting
use it
ledger.
anyway, we're not gonna like it, but they're gonna use the technology anyway.
Yeah, I really don't see that providing a I mean, it may
No, just
provide.
to them, inside of them, as an accountant. I've
Just-
got an accountant
yeah,
who
just
watches my
inside of
books and
them.
watches my assets, and they're just gonna write it all down on a blockchain. And at any time you can review the blockchain, and there's everything. There's no double book entries
No,
here,
right,
buddy.
Right.
That kind of transparency is not.
No, it's not for you.
It's not good for them.
It's
in terms of the
transparency
company.
within it's transparency within Goldman Sachs.
That might not be actually helpful. Like usually the transparency is higher as, you know, people in power want to have more transparency. They don't want you.
Well, they can always
software
expose the
engineers.
blockchain if they want, but they don't have to.
I don't
And
think
if I've
that'll
got a
happen.
shutter business down the street, no one's gonna wanna look at it, and I'm not gonna wanna show it to anyone, but it's my asset management tool. I mean, we're going way beyond currency here.
I got the picture, I think.
They don't work
It's just an
like that.
accounting. It's just fancy. It's better accounting. The blockchain
Better
is
accounting.
better
It's
accounting.
It's three column accounting instead of two. You've got credits, debits, and verification.
So
It's not, oh, I'm moving $10,000 from this account to that account, see, I wrote it down.
Think about investment.
It's no, I wrote $10,000 here and there,
And
and
go
it
on
happened.
Fortune 500 companies, like some
Oh,
of
that
them
happens
go
in
on.
Goldman Sachs. That's the point.
Yeah,
They
no,
don't
no,
want that
no, I
transparency,
know, but
so
I
that
mean-
they don't have to say it to the government. That's why they keep a lot of this. I worked in Bloomberg for 7 years, and yeah, Goldman is
Poor
like the
thing.
most cutthroat company you'll ever
Yeah,
find.
but you don't want like rogue accountant embezzling funds.
Yeah, I mean
You
they
know,
have
that-
ways
it's
of
yeah.
doing that now.
Yes.
So
yeah.
Yes, I just think the blockchain will help them clarify those matters.
no, they don't want that much
I-
transparency. I don't feel that's
Well,
not what they want.
With Goldman, maybe.
Like a higher up.
The higher ups, they have their own methods, but they wouldn't want to create a blockchain where any engineer can look it up.
Oh, no, they keep it, anyway, yeah, I think there's truth to what you're saying, and there are people who wouldn't mind it.
But this is interesting, the counterparty risk, right? So how it becomes like this reputation system, and also like in the blockchain, you don't have all your money in there, right? So
Yeah.
you
Which
can't
blockchain?
really. I mean,
Most
Bitcoin.
of mine's in Doge right now.
I mean, you have some in like fiat currency, etc.
No,
I'm
it's
just saying,
$100.
talking about like counterparty risk, right?
Yeah, like if I wrote a call option, do I have to then go buy all the Bitcoin and just have it sitting there doing nothing because you might exercise the option?
Right.
You know, then that's a waste.
It's a covered call.
Yeah.
It's a covered call, yeah.
So, I mean, what you'd want to be able to do is, you know, I may have other positions, lots of different positions out there, but I don't want to just have to set aside and not get the value of my money.
No, and if
Because
keep
you might
everything at
exercise
Goldman
that.
Sachs, then they know, according to their blockchain, they can see exactly what you're holding, and they can validate your ability to leverage.
So it's like a credit score.
Yeah.
I
So
think it comes down to.
I can see how an over-the-counter kind of mechanism will work here. The trust is an issue, but being able to create an exchange would be interesting.
I trust Options Express to manage with that Schwab, to manage my accounts for me right now. Where's the trust issue?
Mhm.
If Goldman Sachs or Options Express is running the blockchain, I trust them now. I mean, this is not the Bitcoin trust, this is not the cash, but for them to manage accounts, it's just a ledger.
Mhm.
I still don't understand. I asked a question. I still haven't heard an answer. If I'm Goldman Sachs, if I'm an internal organization and I have all the public keys anyway, I just don't see what the point of that is over a traditional ledger. I mean, maybe, you know, from an internal verification perspective, okay, well, I want my spreadsheet, you know, I'm going to sign it at the end of each day, and I'm going to store it in 5 different places with inside the company with 5 individuals. Whoever gets to modify the spreadsheet, I'm going to check the diffs every day and understand what's changed, but I don't understand, you know, the blockchain.
Here's my thought.
Yeah.
I mean, that was just what I was thinking about a second ago. If you're a big company, if you're Goldman Sachs, then you got people around the world, and you might want those people to kind of understand what's happening. And so, it's a way.
I understand what's happening, but if they do anything, I want to know about it. And
Yeah,
if
yeah.
they move $10, there will be a confirmation on my superior reports. They can't double entry and say, oh, I didn't spend it and take money out of the cash drawer.
I think
There's a confirmation next to those double entries.
and they could still reverse it. I think it's just
Well,
an accounting technique is all I think that it would be.
Yeah.
What's the advantage over a nice database?
Confirmation.
When you get confirmation, you can know what happened every day in a database. You can duplicate a database and run a diff each day to compare what's happened. There are all kinds of ways. It's not a problem. It's hard to solve.
I hack and screw databases all day.
And if you have it in a
As one guy.
blockchain, and if you have it in a blockchain, there's no screwing with it. Either the numbers add up or they don't. Every time an asset's moved, you know where it moved, when it moved, that it moved.
Well, that's an append-based ledger. So if every time you append something to a document, you cryptographically sign it,
Yeah.
doesn't that solve the same problem?
That is a
Generally
market.
speaking, but it's more labor intensive.
Well, yeah, but why not do it the old-fashioned way? If the private keys are just going to be...
I'm actually with you in the sense
Yeah.
that I don't think there's a big advantage for them going for a big company. I think they could. I don't think that there's a big advantage.
Is there a small advantage?
It's
Because
programmers might want.
0.01% of $1 billion is enough to live on.
Programmers might like to program on a blockchain. That's a cool thing, right?
Because it sounds, but there's a cost disadvantage, right? It's easy to just take a document and sign it. That's old tech.
Well, you're still going to have the document. You're still going to sign it. This is just like zebra stripes. It's just an accounting
Right,
system.
I mean, the difference with the blockchain is you're just going to have lots of keys.
No,
The
big advantage.
Mathematical
You'll
work
be able
to do the signing.
It's
But you can sign
signatures.
it by email now.
Yep.
It's signatures and it's internal consistency. So yes, so if you're doing both of those, if you're both signing every transaction and you're checking internal consistency, you've created a blockchain.
Well, if that's
So
what we're calling the
you've got-
blockchain, it's very old tech.
is
No,
old
it's
tech.
a
It is
blockchain
very
is
old tech.
is
You're right.
defined
It's
as a
very old
Merkle
tech.
tree of transactions. That's what a blockchain is.
Okay.
So that's the
So we've been using blockchains internally for a long time.
Yes.
Goldman Sachs has had an internal blockchain since 1950.
Yes,
Yes.
the only thing we're debating here is the form thereof. Instead of being paperwork, it's a digital track
the
record.
only thing that the Satoshi solution adds on top of a Merkle tree of transactions is the notion of proof of work as a mechanism of your proof of work function
Verification.
to say that these are that like we don't have to trust our central one store of the Merkle tree. We can keep everybody individually in a distributed fashion can be adding transactions on top of the Merkle tree, and that we can actually merge all of them at the end of the day because of the proof of work
Right.
function.
And that's the part that I don't understand is particularly
So-
useful inside a company that if there's already a centralized entity that has all the keys.
You may want to have much less like a proof of work function lets you have your London office, your Tokyo office, all be running fairly high frequency work transactions. But if you trust everybody already, your proof of work function does not have to be as hard as the Bitcoin proof of work function.
Right, everybody can just have the key. I mean, I guess I could see an advantage if what you want to do is have your London office and your Austria office and your New York office and your San Francisco office all participate in the verification because you're concerned about internal. You don't want anybody to have the key that gets to sign off on the final register because you want a decentralization internally. I can see
Yes.
that. If you want to solve the problem of mistrust within a large organization, then it's the same problem.
Yeah,
Hey, I'm sorry to interrupt you guys. This is a very interesting conversation. Who are the people actually speaking right now? For the people actually listening online.
We're all in one room together. My name's Dan. Who are you?
No,
Who are you,
so
voice
somebody was
out of the
mentioning
box?
the idea of having Goldman Sachs has their own blockchain, and you're right. I mean, in terms of the fact that this is a Merkle tree, and the fact that Satoshi added the decentralized mechanism. Who was one who actually pointed that out? Because I'd like to talk to them off of.
National Security Agency over there.
I'm wearing an EFF t-shirt.
EFF?
That's Zaki Mannion. I'll type it in. I'll type it in the thing here.
I was just going to say one thing, that as a consumer, Goldman Sachs already has a fiduciary responsibility. They send me transaction statements.
This is
As
just an
a
accounting
consumer, I
ledger.
have no benefit, but for internal controls, I mean, how many times do you hear, sometimes you hear about the rogue trader who hit the button and sank a bank.
This kills the rogue trader.
Yeah. I mean, you can really codify internal policies and make accountability. There's no longer this sort of...
Anything happens, it gets reported within, what, a 10-minute settlement period or whatever the heck they call. I mean, if you want to run it on
Yeah, and you can
Dogecoin,
just
it happens in
have
30
graph
seconds.
analysis that's sitting there going, are we outside of our risk controls?
Run it QuickCoin, on a QuickCoin blockchain, and it happens in 10 seconds now for Quick?
What?
Dogecoin's down to 30
How
seconds for
long your
settlement.
transactions take to close is entirely dependent on how much you trust your other parties.
Well,
Yeah, because they
Because
can
it's
roll them
It's
out.
all about how hard your proof of work
yeah,
function
and
is.
blockchain takes 10 minutes to settle, and Dogecoin's big claim is they take 1 minute to settle.
Which is, it's just changing
Yeah,
one value.
I
in
know.
Bitcoin.
So you can run it, that's the question, which blockchain do you want to use? Which model do you want to use? And security's not really an issue for you, because it's all an internal accounting system anyway.
So you could have transactions closed in seconds.
Right.
Or
Tenths of seconds.
bank
Sure.
level computing power.
And you don't need to mine the whole blockchain. You could mine the first coin and then just close it down. Then all you're doing is keeping the mining going for transaction verification. You only need one coin subdivided. You're managing a small company. Goldman Sachs might need to mine 2 or 3 coins.
Okay, we've changed. We've gone off track a little bit.
Yes, we've gone way off track.
It's
Good
going to
job.
stimulate
I think
your
it's very, I
discussion.
think it's very fun stuff.
Fun. I
Just-
like that word.
Just to go back a little bit, are there any questions directly for Jay about derivatives? Any final ones?
Well, I was gonna ask about covered calls and stuff, but just a quick side thing. I can see using this to create options contracts and derivatives and issue all of these instruments. But I still think an elusive goal has been a decentralized exchange. I mean,
That's-
people have like written about that endlessly, but things like price discovery and order matching and high frequency trading on a decentralized exchange, like on a blockchain is,
But does it need to be high frequency?
It will be.
Yeah.
Why does it need to be high frequency?
well, like for example, Bitcoin is what, 7 a second? That's not gonna cut it.
Yeah, well, maybe that's an upside, right? I mean, there's high frequency trading in terms of whether or not it's helpful from the social perspective in finance. It's obvious that some people profit from it.
Oh yeah, suck up the loose pennies.
We'll suck up the loose pennies. It's really controversial. Does it supply liquidity, or is it really a net drain on liquidity?
I don't know.
So the way there's a high frequency Bitcoin exchange that has tentative regulatory approval in New York, and the way they're going to do it is do all the accounting off blockchain.
Right, so I bring that up because
Supply chain
I
for
can't
some.
imagine NASDAQ running with 7 transactions a second. It
No.
doesn't work.
Oh, no,
You're
right.
on 700,000 transactions per.
But before you say it doesn't work, you should know that it's a live proposal. That a lot of
It
finance,
doesn't work yet.
a lot of finance people think that it would be a better system to go from allegedly continuous transactions on things like NASDAQ to very high frequency, meaning twice a second auctions on NASDAQ.
I have a question.
So in other words, it would not be high frequency in the classic sense. So let's say that we had a distributed exchange built on top of Ethereum that had things happening, every 30 seconds. And
Sure.
you're calling, anyway, you just called that high frequency a second ago. But
No, that's not. That's the
Oh, okay.
opposite of high frequency, right? So there's a question, right, an open question. There's a lot of discussion
Okay,
about it,
great.
whether or not
Okay.
in terms of the social functions of an investment platform, right, which is that you want end investors to be able to invest, you want issuers to be able to raise fund well, you want there to be enough liquidity so that people are drawn to it, but you don't want there to be predatory behavior where sort of unnecessarily people are picking up pennies that don't somehow enhance the investment process. It's an open controversy right now whether or not things like HFT are good or not. If they're not
Right.
good, then a solution would be to say, look, here's what we're going to do. We're going to have 10 auctions per second for stock instead of the continuous order book that we have right now. And what's going to happen is you want to buy 10 shares of Apple, you put in your order, and that goes into an order book. That's a bid, lots of bids, and then at the end of that long tenth of a second, the bids and offers are matched, a price is set, and the transaction goes through,
Okay.
and then that happens every 10
That's interesting. I
seconds.
like
So it doesn't matter anymore
It's a different model.
whether or not you're 2 millisecond, you have a 2 millisecond
And those
advantage
guys
over
putting
somebody
straight
else.
fiber from Chicago to New York are kind of wasting their money.
Right, under that system, it's a waste of money.
Can we,
So it's a
can we do
question.
that, can we do that on a chain now? Like that scenario?
Well, so that's
Almost.
a thing that
It's a technical issue, but I think so.
you could turn the cost of proof of work into an advantage if you think, if you're on one side of this debate.
So it's like, so it's settling 10 auctions per second or even 1 auction per second, let's say, for a given instrument, because remember there's 500-600 instruments out there, let's say, on the
Yeah.
exchange.
On the light day.
It's still that's a lot.
Oh, yeah.
Well, the one thing that I like that at least has some attraction to me about Ethereum is that they're looking forward to the possibility of changing the mining algorithm and the protocol in the future. So even though there's not, you can talk about one of the problems that Bitcoin has, this limited number of transactions, is just the architecture of the protocol. And so, anyway, even though I'm not certain that we can do this NASDAQ sort of transaction volume, I think that there's at least people are thinking about that problem.
Is there a way to do it hierarchically where,
Sorry, I was kind of a little bit of a tangent from what you guys were saying there.
No, what
Well,
you're
I think
saying
it's
about doing it hierarchically is exactly what would happen.
Yeah.
Because the fundamental logic of Satoshi's solution is the less you trust someone, the longer your proof of work function is. So if you have some small piece of the hierarchy that says we all trust each other a lot, we can have our own little representation of what's going on that we synchronize with the blockchain at a certain number, at a certain frequency, and have much either no proof of work and just have conventional exchange, or have a smaller proof of work function inside the whole small group.
I was just curious to find out what happened in the case of this derivatives market you were trying to set up for the chemicals that you mentioned.
Yeah, so...
And how would you approach this problem if you knew this new technology existed by then, right? So.
Yeah, so what happened is we got investments. We raised $105 million. We got investments from Dow.
Can I be your friend?
Hmm?
Can I be your friend?
We being not me, we raised a bunch of money from these chemical companies who basically killed it because it created too much price transparency. So, yeah, they killed it.
They're really selling it for $1 when it costs 3 cents?
Well, I mean, these are commodity chemicals, but they would differentiate based on the fact that their quality, they had more capacity, and they felt like that their service was being commoditized by the exchange.
Of course they did.
So it ultimately didn't work. It did work with natural gas liquids, where there was already some trading activity, but then Enron collapsed, and that sort of took off most of the market that was trading natural gas liquids. But it would be interesting. I'm thinking about how I've thought about creating a chemcoin, an industry-specific currency.
Yes.
And what that might look like on Ethereum. Those are some of the things I'm curious about.
Yeah, I mean, I've been listening to this and I'm somewhat familiar with the concepts here, but never really worked for a Goldman Sachs or any other finance company. But to me, it feels like it's going in the wrong direction, thinking about, how can a large financial institution internalize this technology, if I may say so, because you're not really playing to your strength, right? So I was thinking it's more like probably better to approach an underserved market. It could be chemicals or some other thing versus trying to replace a very well-entrenched, well-working solution at the get-go, right? I mean, it's maybe not the best example, but there's a reason why people started, I guess, trading cocaine and other types of drugs because that was actually an underserved market, with the Bitcoin ecosystem attracting that. I mean, well, can we create, more lawful examples of those when it could be
just
on the fringes,
cryptocurrency,
right?
derivatives on cryptocurrency.
Yeah.
There's not available. I mean, that's your low hanging fruit.
Yeah,
So
they're just starting to do options on Bitcoin, but you could do all the others.
Who's doing that?
Second market, I think.
Yeah,
The one-
there's some. You can
Every
short-
Bitcoin meetup I talked to, there's like 3 or 4 startups that are doing something that sounds a lot more like a security than a currency to me.
Yeah, well, I understand why, but I'm curious about how you can short. I was at a meetup last night, some guy wanted to short Bitcoin.
Yeah,
And I didn't know where to send him.
Well,
I
there's
told him he was throwing his money away, but I
Yeah,
didn't
there
know
are
where
a
to send him.
couple of liquid markets. I'd have to Google for them, but there are a couple of liquid,
There are,
relatively
okay.
liquid Bitcoin.
I'm like
They're not in the
I'm
US.
like 2 months into this, so.
Yeah, they're not in the US, but they exist.
Yeah, but it's still fairly new terrain. I mean,
Oh, yeah.
you could get into that. I mean, that's.
But that's part of what these options and derivatives could offer is more price stability, because that's been one of the critiques of Bitcoin is it's so volatile that people don't want to touch it. But if you can hedge around it and create some price stability,
Yeah.
I think that would help.
Sure.
And I think that's what second market is trying to do.
Is a lot different than volatility in China, in Chile, or Argentina. I mean, they think 20% per annum is good.
Sorry, I wasn't there for the first half of the talk, but you were trying to create an exchange for illiquid or...
For commodity chemicals, things like benzene and xylene and caustic soda and chlorine, things that were chlorine and caustic aren't as fungible as those other chemicals, but
You're doing like actual trading company or like swaps?
both, yeah.
Both?
So we had forward contracts and swaps. Dow was swapping xylene in Brazil for benzene somewhere else with someone else. They got pretty crazy and creative.
So you started with brokers, right? Do you have brokers in your? I mean, who does it?
We did hire brokers eventually. I mean, we started
You're
out.
trying to kill the brokers, is essentially.
Yeah, we started out as a classified, chemicals wanted, chemicals for sale, and then we moved into auctions, and then we moved up into commodity trading.
So we tried to do the same thing at Bloomberg for gas, oil swaps.
Mm-hmm.
So it was called OilX, and it was the first real-time swap trading. And the same thing, we couldn't get the brokers to, these guys, all they own is like the phone numbers of different traders.
Mm-hmm.
That's all they have. They don't have any money in the game, and they would not let go of their.
Well, what we found was crazy was with the brokers, the petrochemical brokers, is Hans at this company in Belgium only wanted to speak with, Sven, this one in Sweden. It wasn't that the companies had trust in a relationship. He was only going to deal with that guy. And so trying to manage all of that was...
So, I mean, when you talk about that, right, that's where it really sounds like cryptocurrencies would help. When the scarce resource that people are monetizing is trust,
Mm-hmm.
then that's where it seems like there should be an opportunity to automate that trust with this kind of
Next
technology.
Byron,
Where
can
I'm
you
not
come
really-
next week?
Yeah, I'll be here.
Okay.
Yeah, Jay, I'm gonna email you. I've got a couple of questions about your exchange. I wanted
Okay.
to talk to you. I just don't have time now. So.
Sure.
Yeah.
Good.
Take care.
Thanks, Byron.
So,
No, I don't think so. We were also trying to create an exchange. He tried to create an exchange. Just because you have a solution doesn't mean they will accept it.
Right.
Because a lot of people would lose a lot of money because now it becomes transparent.
Well, I mean,
as you said, they killed it, right? So just having Bitcoin is not going to make people start using it.
I mean, but for everyone who's losing the cash flow, who has a cash flow stream threatened, there's a payer who has a cash flow stream to gain, right? So the advantage is the guy who only trusts Hans is ending up paying Hans high fees for that trust, right? He's not participating in a competitive market because he trusts Hans and he understands that too. He's got a relationship. He understands he's not getting the best commodity price for his transactions. But he also understands he's not going to get screwed too bad. And if he goes to a random person, he might get screwed too bad. So to sell this kind of thing, to get the liquidity, you're right. I mean, no financial system is worth anything until it's liquid, and it's not liquid until it's liquid. It's it's like a nightclub.
That's not true, though. That's what I'm saying. Like, creating liquidity is not in the best interest of brokers and old-time players. So just because you have a better system doesn't mean it will actually, especially for these kind of markets, they just won't. There's enough entrenched power.
Right. No, the incumbents don't want it.
Yeah,
But it's the transactors, it's the end transactors, it's the
I'm with
retail
you.
side that
I think you
wants
need to
it.
go for an underserved market. I like that idea.
It has to be where there's pain. Like, people want to trade in a different way, but they can't because technologically they can't.
Shorting Bitcoin. Shorting.
Or there's
Sure.
marginalized players.
Are there marginalized players?
Marginal, I mean, that's the
A lot. There have to be a lot
That's the
of
value.
marginalized players.
That's where Bitcoin has made such a big why
Yes.
Bitcoin took off when other cryptocurrencies never did, because of the fact that you had a way of reaching out and getting the trust of marginalized players without enormous upfront costs.
Yes. That ain't, yeah. But all these, there's only 450 oil traders in the world. Oil swap traders. So it's it's not a market that's going to be helped by Bitcoin.
and chemicals. I mean, there's one deal that we got involved with where we thought we were going to become brokers before we raised money, and there was a need for 80 million pounds of urea, which is a fertilizer, going to India. And turned out we were one of probably 20 other people chasing the same thing, and we're all trying to put together these, I know a guy who can get the urea, I know the guy who can get the urea, and but it was the credit risk of doing business in India.
Yeah.
That was the problem. So that's an underserved market, an example of an underserved market where knowing that you're going to get paid would help.
That's trust issues.
Yeah.
That's Bitcoin.
So yeah, we should be talking about that. I mean, that's the most interesting thing.
So you throw
here
Bitcoin
is how
into
do
a
we-
sig, multi-sig, and
Like, okay, so you have Ethereum, but how do you trust the guy on the other side?
Mm-hmm.
How do you trust that he can actually pay?
multi-sig.
Well, in most of the applications, there's not this. This is a fairly complex thing. The whole point is that with Ethereum or Bitcoin, you don't need to do that. I mean, you can do things like multiple signature. But
So escrow accounts
Right.
are something that are well supported in
Yes.
cryptocurrencies.
Mhm.
Yes.
If you want to go beyond escrow accounts, now
Talking
you're
about
in
margins, like
now you
protocols and
now
stuff.
you're talking about the undiscovered territory beyond. And I'm not saying that there's nothing out there. There's clearly stuff out there.
He's going to discover it.
Yeah, that's.
But
that's
ultimately, it's legal contracts. You're still writing a legal contract that you will perform.
yeah.
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 And this is a token.
And this is like the mechanics of it.
Yeah.
And who will
but-
enforce it?
The laws to which the contracts are written.
No.
You're right.
The
Who will
blockchain. If you get something structured right, that's what you want to do, right?
No, like Bitcoin's
But for
stolen from
default.
Mt. Gox. Who's going to enforce Mt. Gox? Just
Well,
lost
it depends
300
whether
million.
if you want to use
Not one legal entity is going to go chase that.
Well,
No
if it-
government is going to enforce that.
Well, you
That's
don't.
real money in a way.
But okay, so the reason so here's a great example. So the reason that people, I mean, if you talk to somebody like Andreas Antonopoulos, he would say, the thing is that you should not have left your money on Mt. Gox.
That's all fine, but there's going to be fuck ups. There's also the way you write your contracts. There's going to be bugs.
Yeah,
Sure.
that's what lawyers are for.
And
They're not going
there's
away.
no lawyers.
There's no lawyer.
That's why you get
I
No, what we're
I
saying
lost a
is-
I
bunch of
don't think we
Bitcoin.
want that.
You go and tell your police, what are they going to do for you?
Well, that's if you're dealing with Bitcoin, but if you're dealing with a coin that's backed by Goldman Sachs, it's a
No, we're
different
not
game.
talking about I don't understand where the Goldman Sachs thing came in from. I don't think they're.
Because they'll have their own blockchain. They'll
But
have their own
shouldn't-
coin.
I
Why do
mean,
we
this
keep
is
talking
like
about
a
that?
super,
Let them worry
super
about
high
that
level
themselves.
comment, but shouldn't we be focusing on trying to simplify the things, like these different transactions, instead of like
Hey.
duplicating the complexity on the blockchain? Because I feel like there's so much energy being spent on trying to figure out how to take what we're doing now off the blockchain and like sort of mock it on the blockchain. But instead, maybe there are ways in which we can like just shorten all of these steps, and so we don't have to think about all of these different steps that we're going through right now. Like when we were talking with Preston, he was talking about like taking out half of the flow through the different transactions, and I feel like the same can be said for exchanges and all these different financial tools that we're like talking about right now. But I feel like there's a lot of duplication that's happening between what the current system is and sort of, but I think it's a waste.
That's a good point.
Yeah.
It's just because of the legality, right? You need it on the exchanges for the legal enforcement.
Mhm.
That's
Well,
the
so-
only reason.
I think
Yeah.
I like the idea of you going for simplicity, and I think
Yeah.
if you have a simple solution that goes after an underserved market
That's right.
that nobody is going after,
I
then
think
you can have a
that's where-
great product. But
Yeah.
if you try to go after, Wall Street immediately,
It's not going to work. I
may
mean,
not
I don't think they have any
It's a little bit
incentive
of
to
kickback.
move their systems onto a blockchain
No,
as
there'll
it
be a little
is.
bit of kickback.
And the people that are being underserved, I don't think they want a duplicate system of what's currently happening anyway. So,
that's right.
We call it,
why rebuild what's broken?
we
on
call it paving the cow path versus
Yeah.
using the technology to do something new.
That's what I'm trying to say. Yeah. So, I don't know.
If you don't have access to credit, you don't care that we can't figure out how to do credit on the blockchain.
Exactly. Exactly. So let's just skip over. I don't know. I feel like this is the time to really reinvent a system. I think we have that opportunity for the first time in modern economic history. So why don't we, instead of trying to sort of take a system that is obviously broken and so complex that people can't understand it and requires 70, 100, how many pages was that?
248.
Perspective, 248 pages to talk about
That
one.
was the summary.
Yeah. So instead of trying to figure out how we can make that system on the blockchain, maybe we should take the new technology that we have and reinvent the system completely.
You mean
As a
like
suggestion.
a credit score, which is already. So when you're born, you get a credit score. For each coin. That's the only way, right? I mean,
No, why does that have to be when you're born? You make an identity, okay? So let's say with Ethereum, they'll have a credit score system. It may start out with it in the Genesis block. Maybe it'll be added later on. So they'll have a reputation system.
Yeah.
You make one. You make an identity. You start collecting reputation. Maybe somebody steals it. If you're stupid,
well, that can happen now. So
if somebody steals it,
it's okay.
then you go and create another identity, and you let people know through other mechanisms.
Yeah, I think that's what's going to happen. Something of that form.